Thank you very much. Right, so welcome everybody. So today, I'm just going to do a talk based on the COVID-19 stimulus measures and also a little bit at the end about tax planning in general, given that we're getting close to the end of financial year. So as you know, due to the COVID-19 pandemic, there's been a huge impact on businesses, especially small businesses, which has led to them having massive reductions in their turnover. And also, well, to a further extent, even having to close down because of the restrictions that have been put in place. So to the government's credit, they've come up with quite a lot of measures that can help prop up the economy and also help businesses get through this period. And they're working to roughly a 6-month time frame, because I think the idea is basically that the economy goes into sort of a hibernation period for 6 months and then comes at the end of it once things sort of ease and get a bit better. So what I've done is put together a very high level, due to time constraints, obviously I can't go through everything in detail, but it's a very high level little presentation of what's out there and what's available, more so tailored to the audience being this group. So there may be one or two things that I've left out, probably because it's not so relevant to the people in this particular group. But I'll go through them one by one, and if there's any questions or anything, we can go through it at the end. So to start with, just to let you know, this is very much a general overview. So it's always important to speak to a professional about your specific circumstances, because the way these measures apply, they're not cookie cutter solutions to everybody. Everyone's circumstances are different, and what you'll be eligible for and how much you can get, and what's out there will differ from person to person and business to business. Not everybody operates their business through the same structures, so it's very important to sit down and go through everything before you act. The questions I touched on, and then also I'll give you the contact details at the end if anyone wants to get in contact.
Hey, Ranga, you can share your screen if you want, mate, so we can see the slides.
Oh, sorry.
No, you're right. I just thought so.
Let me try that again. Oh, sorry, I was supposed to do that.
And there should be a share screen feature.
Share screen.
Yeah.
It'll be.
I think if you go to video.
Yeah, there we go. Yep, we can start.
You guys can see it?
Mate. Yep, perfect.
Cool.
Nice.
Yep. Sorry, just bear with me.
Yep. Perfect.
Swap that over.
Perfect.
Okay,
Mate.
you guys can see the slides?
Yep.
Excellent. Sorry about that. Anyway, that was the opening slide. That was the second slide. Okay, so we start with the first measure, which is the $1,500 JobKeeper payment, which is probably the most popular one that people have been hearing about that's out there. As the name suggests, the JobKeeper payment is designed to help pay wages of the employees in particular jobs, but also sole traders and self-employed as well, just to keep individuals in jobs in particular entities. So what this is, from the 30th of March for up to 6 months through to September, we're looking at a $1,500 before tax per fortnight per employee wage subsidy that's paid through employers to their employees. And it's administered by the ATO. Now, there's a 4-step process. So basically you enroll, you have to meet the eligibility criteria, you have to nominate your employees or your eligible business participants if you're a sole trader, and then you have to make sure if you have employees that you're paying them, you also have to keep notifying the ATO of your income details as you go. Now, mainly, just at a high level, you're looking for small businesses. That's any business with a turnover of less than $1 billion. You're looking at a 30% downturn in revenue to be eligible as a general rule. Obviously, there's other criteria out there, but comparing say, a period 12 months ago, or using the alternate test even slightly earlier if you started business within a 12-month period of the month of March 2020, you're looking for a 30% or greater downturn in your revenue to be eligible, as a general rule. Also, you must have employed, or if you're a sole trader, you must have been in business as at the 1st of March. Again, along with other criteria about lodging your returns and activity statements. But they're the two key ones. So as long as you meet these criteria and then go through and tick all the other boxes, you may be eligible for this JobKeeper payment. And as I said before, it also applies to self-employed and so sole traders as well. The key thing here is once you've met the criteria and you start receiving the payment, if your circumstances change going forward, my understanding is you're still eligible for the payment, but it's just important to keep reporting as you go, because the ATO will take that information and just monitor things going forward. But that's quite a popular one for people who are running a business with employees, or if it's just a sole trader business on your own, you can definitely tap into this, provided you meet the criteria. So have a look at that one. The next measure out there is the cash flow boost. Now, this one, well, what it looks at, rather than it helping out with paying wages for employees, this is in fact, you could look at it as a reimbursement from the government of the tax that you pay on wages to your employees, right? So normally when you pay your wages to your employees, you're looking at paying PAYG withholding on those, which is paid to the ATO, and then the net amount obviously is paid to your employees. What this is a reimbursement of that amount. A minimum of 2 lots of 10,000, giving you 20, or a maximum of 2 lots of 50,000, giving you $100,000 in 2 rounds. So this applies to businesses with an annual turnover of less than $50 million who've made payments to staff by 30 June 2020. And it's triggered by lodging your activity statements. So your March activity statement, the one for the quarter ending 31 March, will be due on the 26th of May, I believe, if you're lodging through an agent. You may have already lodged this, right? If you're lodging it yourself, because it would have been due on the 28th of April. However, that is the trigger for receiving this amount. So you don't have to apply for it separately. Once you lodge your activity statement, that debt for the PAYG withholding will be, I suppose, offset by the ATO. And then any amount above that, so let's say the wages withholding amount was, say, $5,000, but you're entitled to the minimum of 10, 2 lots of 10, then the excess would be refunded to you in cash, is my understanding. And then, as I said, it's split between 2 amounts. The first amount is an initial amount, and the second amount is an additional amount. The additional amount is basically the same as the initial amount. So it's just 2 lots of the same amount. And it'll differ depending on whether you're lodging on a monthly basis or a quarterly basis. And those calculations are done slightly differently, but that detail I can provide if anyone wants later on. The other thing, yeah, you just have to have paid staff between the quarters of 1 January 2020 to March 2020, and then April to June 2020. And that also includes not-for-profit entities. And also businesses must have been established by that 12th of March date. So that's the cash flow boost. The next cab off the rank is the instant asset write-off. This is quite a good one because previous to this, out there, if you were a small business, then you were only entitled to an instant asset write-off, which I should say is a ability to claim a tax deduction for the full amount of a particular asset that you buy to use in your business, right? So to give you an example in that last line there, let's say you have a delivery business and you buy a van or a truck. Now, previous to this, if the cost of the truck was more than $30,000, you were not able to claim a deduction for the full amount in this financial year. However, what's happened, obviously with the pandemic, the government's looking to drive investment and get people to spend if they can. So they've increased the asset write-off to $150,000. And the eligibility has gone from, I think, small businesses being less than 50 million to 500 million. So basically that's, I think it's like 97% of businesses out there now are eligible for this write-off. So as long as you're under 500 mil, which most people would be, and you purchased an asset and have it ready to use and installed by the 12th of March, so between that date and before 30 June 2020, right? So you've signed the contract, you've purchased it, and it's there in your business ready to use, you're entitled to claim this tax deduction for the full amount, provided it's below 150. And if you're, I should say, if you're registered for GST, that's GST exclusive cost is 150. And the last thing there must be obviously a direct relationship between the asset you purchase and your business. So if you run a delivery business, you can't go out, buy a TV and then try and claim a tax deduction for a TV that costs, $30,000 if you don't really use it in your business. So it's important that there's that link there. So that's quite a good one. Now, the next one sort of follows on from the previous slide, but what it is, it's the accelerated depreciation. Now, before I get onto this, I should say, it's my understanding that the 150,000 that was on the previous slide that is up until 30 June will revert back to $1,000 from 1 July 2020. So you've got that period there between March and June to claim what you can, but then after that, it's going to go back to quite a small amount for what you can claim the full tax deduction for. So I suppose to cover for that, what they've done is provided this accelerated depreciation. And what it is, it's an ability to deduct 50% of the cost of an asset, right? And then once you've claimed that 50% of the cost, then apply depreciation on the remaining amount. So to give you an example, if you were to purchase an asset for, say, $500 after June, you'd be able to claim the whole amount because it's less than $1,000. But if the asset cost you, say, $5,000, you wouldn't be able to claim the whole amount. So what you do is you'd claim 50% of the cost, being $2,500. That's one tax deduction, and then the remaining $2,500, you would apply the normal depreciation rules too. So in effect, you're getting 50% more as a tax deduction. Now, the key thing here is, it also applies to businesses with a turnover of less than 500 mil, so that's just about everybody. But the key thing here is applies to new assets only, not second-hand assets, whereas the previous slide applied to new and second-hand assets. So that's a key thing to remember there. Now, this accelerated depreciation goes from 12th March 2020. It applies to assets that are purchased and ready for use between 12 March 2020 and 30 June 2021. So it's an extra 12 months on the previous slide. The next subsidy or stimulus measure to talk about. I'm not sure how many people this applies to, but there's one out there in relation to apprentices and trainees. Basically, it's a wage subsidy of 50% of an apprentice or trainee's wages for up to 9 months. So from 1 Jan 2020 to 30 September. And it's accessible to businesses with less than 20 employees. So employers will receive up to $21,000 per apprentice, which is $7,000 per quarter. Now, the thing here, it applies to employees who had an apprentice there. Let's write this down. That's right, from who've been paid by 1 March 2020. So it's important that person was within the business at 1 March 2020. However, I believe if that apprentice was let go by a small business because of the downturn, they couldn't afford to pay them, and they were picked up by somebody else later, then that person, being the second business that picked up that apprentice, can claim this subsidy, provided they're able to prove that this person was let go and then picked up subsequently. So there are little, idiosyncrasies about how these things are done, but that is a good subsidy there for people who have apprentices or trainees. Right, moving on to unsecured business loans now. With this one, so the government will provide, obviously cash flows are a big issue for businesses at this point. People who have rented office spaces, as well as utilities and wages and things like that they have to pay. If you are short of cash flow, the government's providing a guarantee of 50% to small to medium enterprise lenders for new unsecured loans to be used for working capital. So it's got to be used for the actual running of the business. You can't borrow the money and then use it to do up your house. Now, the loans will be made to a maximum size of $250,000 and then have a loan term of up to 3 years with initial 6-month repayment holiday. They'll be in the form of unsecured finance, which means you don't have to put an asset up like your house. However, I believe that you may have to provide guarantees from a director of a company also, if that's the case. So just be wary of that. However, it's worth speaking to your bank. I know Westpac and a bunch of other banks out there are providing some pretty good packages, also offers like this. So just have a look to see what's out there and see if it suits what you're looking for. Okay, moving on to some other measures that are not so major and in the news as such, but are still very relevant to what we do in business. Now, if you're running through your business through a company, obviously solvency is a big issue, the ability of the company to be able to pay its debts. And so what's happened is we have a company solvency safety net now, where there's a temporary 6-month increase to the threshold at which creditors can issue a statutory demand to a company. And that's increased from $2,000 to $20,000. And also there's been an increase in the time companies have to respond to those statutory demands from 21 days to 6 months. So if there is a statutory demand issued to a company for that particular debts, then actually when I say particular debts, it is in relation to debts in running the business. So it must be things like wages or rent, or it must be a genuine case of being affected by the pandemic and the restrictions, because you have to close your restaurant but you're still paying rent, that kind of thing. It's important to remember that it doesn't mean you don't pay the debt anymore. You still have to pay the debt at a later date. It just means you get this 6 months grace. Also, the next point there is a temporary 6-month safe harbour from directors' duty to prevent trading while insolvent. So directors of a company are not allowed to trade if they know that their company is insolvent and not able to pay its debts. So there can be quite harsh and severe penalties for doing such a thing. But in this period, again, there's a safe harbour that gives people a 6 months grace, given that they're going through this hardship. But the main thing here is that it's under the expectation that the directors will be able to come out of this after 6 months and then resurface and continue. So if you think your business isn't going to be able to make it out of the 6 months, then the safe harbour may not apply, because there are still harsh penalties for trading a business that isn't going to make it. So again, it comes down to your circumstances. Not everyone's the same. Make sure you speak to a professional about these things. The next point there, the ability to reduce PAYG instalments to 0 for March. So what this is, PAYG instalments of tax is what this refers to. Now, if you've had to pay tax in a particular financial year, you had a quite large tax payable, it usually means that you have to pay income instalments the following year in quarterly amounts. So what this is doing is allowing people to vary that instalment down to zero, right? And then apply for a credit. Now, the date for the March instalment may have already passed, but there is the possibility that if you go to the ATO, you could possibly get a refund for these amounts, because you are actually allowed to apply for a refund of the September and December amounts if you need that cash for running your business. So worth looking into if you're eligible for that, to help, I suppose, finance the day-to-day running of your business if you've been severely affected. The next point there is a 6-month deferral on payments of activity statements, income tax, FBT, and excise duties. So if you have a tax payable, you've just lodged your 2019 tax return, which is due in 2 days' time, or you've just lodged your March BAS and you've got a tax payable there, then the ATO is offering up to 6-month deferral of on payment of these things, again, but it's for people who have been affected by the pandemic and are genuinely in a situation where they can't pay this because they've had to pay wages or rent or something else, or even worse, they're struggling to put food on the table. So these options are there, but again, you need to make sure that you meet the criteria and you are eligible for them. Moving on to some other measures. Now, what this is, so it's an ability to move from quarterly to monthly reporting for those who need access to GST credits quickly. So you may be in a situation, especially for the quarter of March, where your income is down, but your expenses are still what they were before, because some of your overheads might be fixed. And for that, and if you're registered for GST, it could mean that you're entitled to a GST refund for that quarter, right? If that's the case, then if you're reporting on a quarterly basis, you may not be entitled to that GST credit until May, or even for the June quarter, it could be later. It could be until July, August, until you lodge your BAS. So the ATO is offering people who are experiencing hardship to move from a quarterly reporting frame to a monthly reporting framework, just to be able to access those GST credits quicker. There's also bank support for landlords who do not evict their commercial tenants. I believe that applies to loans of less than $10 million. So if you're a landlord and you have a commercial tenant and you're doing the right thing by not evicting them, even though they're going through some hardship, banks are stepping in and helping you out. So there's something there. And the next point there I briefly touched on earlier, just the deferring of loan repayments. It's not just business loans, but also residential loans, people who've lost their jobs. If you speak to the bank, some banks are giving a 3-month deferral on the loan repayments, and then reassessing after 3 months, and then possibly giving you a 6-month deferral. Important to note, though, it doesn't mean you don't have to make those payments at any point. You still have to make them later, and interest may still accrue. So just keep that in mind. But it is some sort of help. And another thing that that last one we touched on earlier, just the small business grants. This important to say, all the other measures I've talked about up to this point are federal measures. This last one is a New South Wales state-only measure. It's a $10,000 grant to small businesses, which I believe only applies to people who employ staff. So just bear with me 2 seconds. I'll find. Here we go. So yeah, so this one is for eligible businesses that have between 1 and 19 staff. So if you've got less than 20 staff and you have turnover of more than $75,000 and your payroll is below 900, which if you're a small business, it could be, then you may be eligible for this. It's more so to help out businesses who've been highly impacted in certain industries, such as retail, accommodation, real estate, arts and recreation. These are people who've been really affected by the closures and restrictions in place. So there are grants out there at a state level as well to be able to access. Now, just a couple of last slides to finish off with. Support for individuals, we've got the job seeker payment, which is different to the job keeper payment. This one is basically, it's designed for individuals, but it's been extended to sole traders and also the self-employed, as well as casuals and contractors who've had their income reduced to below 1075 for a fortnight. Initially, this is only for individuals, not businesses, but it's been extended to sole traders. However, it is income tested. So I believe if your spouse income is above that 79 figure, then you may not be eligible for this. But obviously that's not the only criteria. There are other tick boxes you have to check. So make sure you go through the full list before you work out if you're eligible for that or not. It's important to note that you can't claim job seeker and job keeper. It's one or the other. It's important that you keep that in mind as well. Also for individuals, like we have the solvency safety net for companies, there's a bankruptcy safety net for individuals, which is basically there to, if an amount of debt required by a creditor to initiate bankruptcy was 5,000, now it's become 20,000 to initiate those proceedings, and the time to respond to those bankruptcy notices has gone from 21 days to 6 months. If anyone gets in any real hardship, those fallback measures are there too. Just to quickly touch on superannuation, this one's been in the news quite a bit. The early release of up to $10,000. Again, this is really for people who've been severely affected by the pandemic, people who've lost their jobs and have had to dip into super because they've got no other source of income. What the government was doing is basically providing 2 lots of $10,000, one lot now in the 2020 year, and then another $10,000 in the 2021 year up until the 24th of September. It's basically designed for people who've received a redundancy or employees who've seen their working hours reduced by 20% or more, but also applies to sole traders where their businesses were suspended, or there's been a reduction in their turnover by 20% or more. Again, they're only the major criteria. There are other things you need to meet as well, so keep that in mind. And I believe it's not a tax-free withdrawal. There is tax to pay on those amounts if you do take them out and you are eligible for them. However, actually, sorry, no, they are tax-free, but they won't affect your Centrelink or veterans tax affairs amounts. And the last slide here, just a few tax tips, I suppose, getting close to 30 June. These aren't so much out of the stimulus package, but just general tax tips to keep in mind, given we've got probably, what is it now, 2 plus probably 6-7 weeks until the end of the financial year. Some things to keep in mind. Given a lot of people have had the last 3 or 4 months of this financial year affecting their businesses in terms of their income, it's important to think about the timing of the derivation of your income now. So if, for instance, your expenses haven't changed and your business looks like you might be making a loss for this year based on the numbers that you've looked at up until the start of May, then it might be worth bringing forward some income that you were maybe going to invoice close to the end of the financial year or in July. Look at bringing that forward into this particular financial year so that you can absorb some of those losses. But if your business hasn't been affected by this pandemic at all and you're still having a bumper year, then maybe think about pushing back some income rather than invoicing on June 30, invoice 1st of July, 2nd of July. Then if you're on a cash basis, you pay tax on that 12 months down the line. Same thing with your expenses. Think about the timing of those expenses. If you're not affected by the pandemic and you're having a pretty good year, think about bringing expenses forward, reduce your profit. At the same time, if for whatever reason you can delay expenses, then if you're in a loss position now, then you may have no choice if you're affected by the restrictions at this point. Some other things that you could do, not so much if you're affected by the pandemic, but things, people with rental properties and also businesses, think about spending some money on repairs before 30 June. As long as they're not capital, like substantial works, as long as they're just genuine repairs, it's a good way to bring down your taxable income, bring down your profit, as long as they're tied in with your business. Think about donating to charities if you want to reduce your taxable income in that way. Again, make sure they're a registered charity that has a deductible gift recipient status. That's important. If they don't have the DGR, you can't claim the tax deduction. But the donations are a good way to reduce your taxable income if required. If you're a business out there that has some debts which you don't think you'll be able to collect on, good idea to write those off before the end of the financial year. That's always a good way to get a tax deduction through your business as well. Motor vehicle logbooks. Now, this is always one that people don't think about until it's too late. Usually, so with a logbook, so there's two ways of claiming motor vehicle expenses. You can either use the ATO rate, which is a cents per kilometre method, or you can use a logbook method for your actual expenses. Now, the cents per kilometre rate is capped at 5,000 kilometres. So if you do a lot of driving, the logbook might be your best bet. But also, if you use your motor vehicle quite a lot, then the logbook still might be a better outcome for you. What it is, it's a 12-week register where you monitor all your driving, and then you work out the percentage of business kilometres over your total kilometres to work out how much you can claim. Now, you're probably thinking, well, there's not 12 weeks left in the financial year, but that doesn't matter so much. As long as you start your logbook in this financial year, we've got 7-8 weeks left in this financial year, then you'll have another 4 or 5 weeks afterwards. As long as you maintain that logbook in that period, that percentage you determined is valid for 5 years, provided it doesn't change too much going forward. And you can apply that to things like your registration, your insurance, your repairs, your petrol, things like that. So worth doing if you think it'll be a benefit to your business. And the last thing is just depreciation. Keep in mind it's an asset write-off. Claim deductions where you can, keep your tax down. Hopefully your business hasn't been affected too much. And this way you can pay no more tax than you need to. So what does this mean for you? It's important that before you take action on all these things that I've sort of touched on, because this is very high level, it's important that you understand your specific circumstances and how you're impacted by these measures. I know I've thrown up some figures like 150,000 instant asset write-off and all these things, which sound great. There are things in the fine print that you need to work through and make sure that you can meet before you go out and buy that vehicle or buy that piece of equipment that you really needed. So make sure you speak to a professional, make sure you get the right advice before you act, because you don't want to find out later on that you can't claim what you thought you could. And yeah, please feel free to get in contact if you want to discuss your particular business. That's my details at the bottom. All the best.
Thank you.